Okay, welcome everybody. I see a few are logging in. One from Ireland, USA. Let's just wait for others to join and then we'll give them a moment. Again, welcome everybody to our first property webinar of 2025. I'm John Sparks and I'm thrilled to have you joining us today. Joining me today is Matthew from Cape Town, South Africa, from Global Residential, and he'll be providing us with valuable insights into the program as well, and an incredible project that is part of this program that he will share with you. In this session, we will be exploring an exciting opportunity that makes property investments more accessible than ever. We'll discuss this exclusive program, which allows investors to pay their deposit over time during the construction phase. And this makes it much, much easier for a lot more people to get involved with property investments. We'll then have a live Q&A afterwards, and you can ask as many questions as you want. Okay, so let me briefly introduce myself, and then Matthew will introduce himself. I'm, as I said, John Sparks. I hold a Bachelor's of Commerce degree majoring in accounting, statistics, and tax. Being a certified planner, I specialize in investment properties. That is my game. That's what I love, and that's what I do. Throughout my career, I've been part of and successfully written over £100 million worth of property transactions. And doing this, I've spent the last 35 years living and working in 9 countries across the globe, including Antarctica. So that's me in a nutshell. Before we get into the program and what we're going to discuss, just a few points on why property. Investing in property is a proven track record, and it gives you returns year after year after year. Unlike other investments that may fluctuate, property is very, very stable, and it makes it a robust choice for wealth accumulation. It then has a dual wealth generation. This is a very, very important part of property, as you enjoy 2 streams of income: rental yields from your tenants, and then obviously your capital growth as property values increase over time. And this dual approach can and does significantly enhance your overall returns. Then another very, very important one that no other investments allow, and that is your leverage opportunities. Investors can maximize their potential returns by using a mortgage finance. And essentially, this allows you to control a much larger asset with a smaller initial cash investment. And this leverage really amplifies your profits. And then, as everybody knows and understands, real estate is and property investments is a hard asset, and it can balance out the volatility of stocks and other investments that you have in your portfolio, giving a lot of stability to your portfolio. It is a very low risk asset. It's brick and mortar. You can go and look at it. You can knock on it. You can take photographs of it. It's there. It's a structure, compared to stocks and bonds, which is paper, really, at the end of the day. So it's really safe to say that, you know, and it's a very, very low risk. In fact, no risk at all, that you're not going to ever have a total loss going into a property investment. Then, for me, the most important, it hedges against inflation. You know, property acts as a complete hedge against the inflation rates that rise year in, year out. Your property values and rental income will always increase as demand increases. An important fact here, and I'll bring it up a little bit later again, is that property has always, can I say, outperformed inflation over the last 100 years. Yes, maybe 1 or 2 years. In fact, I think 8 of the last 50 years, for the particular year, it's been under the inflation rate. But on average, it outperforms inflation. and it has over the last 100 years. So staying on inflation just for a second, because I really like this slide. I call inflation the silent killer. It really steals your wealth unless you're in property. So let's use an example. 1974 to 1924, the average world inflation is 3.71. Is it going to decrease over the next 25 years? I don't think so, because January 2025, the average inflation of the world has gone up to 4% because of what we've just had. So let's talk 3.71%. So we've got a choice today. We can buy a property for £100,000. We can then go with that £100,000. All you have to put in is £25,000. So if you've got £25,000 in your bank account right now, you can buy a property for £100,000. So you've got two choices. You can either put it in the bank and leave it there, or you can put it into property. Putting it into property, let's take a 25-year view on it. In 2050, using 3.71% as your inflation rate, and as meaning the property is going to increase 3.71% in the next 25 years. After 2050 comes about, you sell your property. It will be worth 248,000 just because of inflation. You pay back the bank the £75,000 because that's what you've borrowed from the bank, giving you a net wealth gain of £173,000. So you've turned your 25,000 into £173,000 in 25 years. But remember, we've got rentals. And magically, from this £25,000, you've received £177,353 worth of rental in your back pocket. That's after you've paid your mortgage. It's after you've paid all the service fees, the management fees. That is your net into your back pocket. And I'm only using 3.71%. So I'm being very, very conservative. So out of this 30,000 investment, because unfortunately you've had to pay 5,000 stamp duty on it, you've actually created 177,000 plus 173,000 from your capital growth. So your net wealth gain is 313,000. That's 313,000 that you have made from your 25,000. Now, if you had left it in the bank, how much would your 25,000 be worth because of inflation? It would have been worth £9,000. So you've actually lost 64% of your wealth. So would you rather have £9,000 in your back pocket in 2050 or 313,000? It's a no-brainer. And we need to get into property investment. And the problem getting into property investment is why we're here today, is the lump sum of having to buy into property. If you go and buy a property for £200,000 right now, you've really got to come up with at least a 20% deposit. And most people haven't got that lying around. So I'm going to explain how we can get into these property deals. We have property deals on this payment plan from £130,000 all the way up. And it just is a matter of your cash flow and how you want to strategize your next few years. So as we've discussed, why property is really a good option, we've got to look at this lump sum. We've got to look at how we can get this lump sum, these payment plans to buy property. So we've joined up with exclusive people like Matthew on the call today, and we've done a program with them that allows us to get into these properties with a payment plan. And it's an exclusive payment plan with the developers. It's a game changer. It really is a game changer for investors like myself and like everybody that's on this call and other people. So imagine being able to invest in property without the daunting task of having to come up with a big investment. It's mind-blowing, okay? And your payment plan can be done in quarterly, monthly, semi-annually, if you really want to do it that way. But what we always suggest is that we do it monthly, because it just keeps you up with the payments, okay? This opens the door to a lot of people, a lot more people now, okay? It really brings a lot of flexibility to being able to create a property. And it's very, very achievable, really, really achievable. So let me just give you a little sort of diagram on how this whole thing works. Okay, so we got a £200,000 property presented to us. We want it, but we have not got that 20% deposit of £40,000. It's just not, it's not in our cash flow. And we have to have that by February 2025 if we want to buy this property of 200,000. We don't, okay? All we need is 5%, okay? I'm going to give you two choices today here. Okay, so we need 5%. So we put £10,000 down. That's it. We then look at where we can in the market. If we believe we can get an 80-20 loan to value, or what we always suggest, a 65 to 35% loan to value for people, meaning that you put down a 35% deposit. A lot of these developments, the surety of the development actually is the surety of the loan that you're taking out. But, we've got some people out there that can, and Matthew actually said to me just before the webinar started that he managed to get a 2080 loan to value for a client, and a South African client. So it can be done, and it is out there. But for the average Joe Soap like myself and that, we look at a 65-35%. But let's look at an example with a 20-80%. Okay, so for 18 months, because now this unit is going to take 18 months to be developed. So it means that the title deeds are there ready to be handed over 18 months from now. So then we'd break up the 15% that is still owed for the deposit into 18 months, meaning that we'll pay £1,666 per month. Okay. Come August 2026, on a 20% to 80, we don't own anything more, but sometimes the mortgage house might come back to you and say you need to put more money in. There might be a 30,000 lump sum that you need to put in. But let's just carry on in the fact that you get your 80 to 20% loan to value. Got to pay your stamp duty of 10, your legal fees of 2,750, the furniture pack, they go between 2,000, 3,000, 3,500. It really depends on the development that you're in and the area that you're renting, the demographics of where you're renting it. But really a £2,000 package is doable and very doable for a rental property. And then we will go and help you get your mortgage for the other 80%. At the moment, we're looking at 5.5% on your loan at the moment. All indications are telling us that that's going to come down. So who knows? In 18 months from now, it could be a lot less than 5.5%. But I'm South African as well, and we do a lot of South African selling. We've got 5.5. The other day, one of my clients who works for himself, does not work for a big institution, which does give us some headaches when you work for yourself. But he got a 6.1% for 2 years, and after that it will come down. But on average, we're looking at a 5.5. If you're a UK citizen, it's less. So we look.
Yeah, John, just on that point. So this meeting that we just had with the mortgage broker, UK passport holder, resident in South Africa, we were able to get 80% loan to value and interest rates of about 5.05. So that just gives you an indication on where the market's moving.
There you go. There you go. I mean, that's music to everybody's ears, really is. So really, at the end of the day, you've got this £200,000 investment book today for £10,000 instead of £40,000. It really opens it up to a lot more people. If we just go into I'll just go through this very, very quickly. Let's say we are going to look at a 65-35 loan to value. It's 3,333 a month. Okay, so you pay that for 18 months, and really come August 2026, when you're ready to get your title deeds on this property, you owe nothing. All you have to do, that's for the deposit. You pay your stamp duty, your legal fees, will be about 2,750. Your furniture pack, 2,000. The same thing happens. But again, look at the difference in your mortgage, okay? Because it's a 65-35. So instead of paying 733 a month, you're going to be paying 595 a month. And that means, and I think Matthew will go through it shortly, on money in your back pocket every month. You know, we only go into cash positive developments. We're not interested in developments that we're going to have to carry on putting money in after the building has been completed and we've got tenants in it. So we only interested as investors in money, in liquid cash that comes into our back pocket. So again, on a 20-80 split, you might have a little bit less on a monthly basis coming into your pocket, £200, but you know, and that's continuous. So that 595 is on an interest-only mortgage that doesn't change for the next 25-30 years, if you can just keep the interest-only mortgage going, which most people can. So really, that is how we build this payment plan. Very, very, very simple. Yeah, and then I'll you know, in conclusion, it's really what we've discussed, and you know, I can send the slide to people when that are on this call. I'll send the presentation to them, and they can go through it then. But really, it really overcomes the barriers of not being able to get into property investment because of the lump sum. Okay, Matt, this is where I'm going to hand over everything to you.
Perfect. Thanks so much, John. I'm just going to share my screen and then we'll go through the presentation together. So can you see that?
It's still going to come up. There we go. Yeah.
Okay, perfect. So just touching on your points, obviously we're looking at UK property investment. It's a really good hedge against inflation. But then also, if you're resident in South Africa or other African jurisdictions where I look after, you need to factor in currency depreciation and acquiring a primary currency asset. Now, a bit of a background on myself. So just waiting for my screen to load. Sorry. Just give me a sec. It seemed to be experiencing some difficulties, well, some technical problems. As with everything. Okay, perfect. Let's try this again and see if it works. Okay. So just a bit of a background of myself. So obviously, as John's introduced me, my name is Matthew Hogard. I'm the Regional Head of Sales and Distribution for Global Residential for Africa. I've worked for two of the largest independent financial advisories globally until I recently took up my role at Global Residential at the end of 2023. I've got a degree in economics and finance from the University of Cape Town, and then also my Chartered Institute of Securities and Investments level 1 to 3. So that's why I've taken up my role at Global Residential, mainly from the investment point of view, as well as my tax expertise. Now, when you look at UK property at the moment, the main thing we need to look at is price points, because it needs to be affordable and we need to identify certain regions in the UK. Now, if you're looking at London, this is from Rightmove. The average property price that you're looking at in London is 677. Now, where we've taken a keen focus is on the Northwest region and the Yorkshire and Humber region, because even in a high inflationary environment and high interest rate environment that we've seen in the last 2 years, they've still outperformed the UK average. But the main reason why we focused on them is that if you're looking at London, you'll be struggling to get between a 4.5% to 5% yield on your property. Whereas the Northwest and Yorkshire and Humber region, you're averaging about a 7% yield. So that's obviously critical, especially if you have a mortgage, to make sure that your cash flow is positive on a monthly basis. Okay. Now, a key trick when people are saying, where's the best place to invest in the UK? The key is to follow the money. So if it's the old money, you're basically looking at London, Cambridge, Winchester. The new money is starting to flow towards Manchester, Birmingham, and Liverpool. And then this is a key one. Where's the smart money? So the banks, the build to rent schemes, the pension funds, where are they sitting up? And that's in Leeds. It's actually the second biggest financial hub outside of London, outside of Canary Wharf. So that's why we've taken a keen focus on Leeds when it comes to our projects. And this is where we introduce our project, the One Residences in Leeds. Now, why Leeds? So Leeds, the Yorkshire and Humber County is a £150 billion economy per year. And Leeds alone makes up £60 billion of that, or 40%. It's also home to 1.25 million people workforce, 75,000 students, and 5 major UK universities. So if you're looking at it from an education planning point of view, it's also really good to have a part of your portfolio if you want to send your kids to school or universities in Leeds. Now, we were struggling to get a site in Leeds for over a year, and the main reason being is that it's dominated by the build-to-rent schemes. Who are the build-to-rent schemes? They're the big banks and pension funds. And essentially what they do is they go in, they snap up land, they develop, build their development, but then not sell them on to end users or clients or buyers, but hold them as a part of their portfolio. So if you are able to access that same growth play and sit alongside those major institutions, you're going to experience the same growth play, which is obviously very exciting. Now, one of our non-negotiables when we take on a project is there needs to be regeneration going on in that region or city. And this is no different with Leeds. So there's £500 million going into what's called the South Bank regeneration. What does that consist of? A new business center, a new library, a new poetry center, improvements to the railway system. And our project sits on the edge of the city center and north of that South Bank regeneration. So 3 words: location, location, location. There isn't a better location in Leeds. Now, this is Savills and their forecasts over the next 5 years, where the UK average is going to be growing at 21.6% over the next 5 years for property. London right down at the bottom at 14.2. The Northwest and Yorkshire and Humber region are right at the top at 28.8 and 28.2% respectively. So that's where we've seen a key identifier in the market to get really good growth over the medium to long term. Okay. Now, when we take on a developer, we need to tick 3 boxes, and those are non-negotiables. All right. Firstly, the developer needs to have a minimum track record of 10 years. So Gareth and Zach have over 37 years between them. They've developed over 40 projects in the UK, with some of the projects down there below. So we're really comfortable in that. The second box that we need to tick is the development needs to be fully funded. So clients' deposits are not going towards the build. That's something that's very important to us, but also that there needs to be a deposit protection structure. So just in the unlikely scenario that the development doesn't go ahead, at least clients' deposits are protected so that they can get them back. And those are the 3 boxes that we've ticked with this developer. Okay. Now, these are some major locations in Leeds from our development, but instead of reading through these, I'm going to show you on a map. So essentially the One Residences is this black circle at the bottom. To Leeds city centre is less than 1 kilometer away. But as you can see from these gray circles, you've got the likes of PwC, Deloitte, KPMG, Ernst & Young right on your doorstep. So what you're going to find is that tenants that are working at these institutions are going to be renting your unit and providing rental income, not only to cover your mortgage and other fees, but to put a bit of extra money in your pocket every month. Okay. Leeds University is less than 2 kilometers away. Leeds Beckett is also less than 2 kilometers away. So again, like I say, as an education planning tool, this development is really good if you're wanting to send your kids to university in Leeds. Okay. Now, this is a makeup of the apartments, which John has gone through in a little bit of detail. But essentially, there are 125 units. There's 54 executive residences. What are those? Those are studios, but slightly larger. They work really well on a short-term letting or Airbnb model, which is permitted in the development. There's 49 one-beds, 11 two-beds, and 15 three-beds, with those the starting price of each unit. The rental yields you're looking at on a normal long-term rental are anywhere between 5.7 to 7%, so really strong yields, well above the UK average. It comes with a 999-year lease, which is obviously very good, and a low service charge on the development. Completion is Q3 next year, so that gives you some options on your payment structure that John's talked about. Okay, this is a makeup of the units. So executive residences are going to average 39 square meters. One beds will be en suite, some with kitchen islands, averaging 45 square meters. Two beds, again en suite, some with kitchen islands, averaging 76 square meters. And then the three beds, some come with outside balconies or terraces. I'm not sure how good that's going to be with the weather in the UK, but at least you've got that option. All right. Now, these are the makeup of the units. So the first column here is the makeup of the units, so executive residence, 1, 2, or 3 beds. The second column here is the price of those units. Third column here is your monthly rental income on those units. The fourth column is your rental yield, so your annual rental income divided by your purchase price, giving you a yield percentage. And then the fifth column here is a 20% deposit on those properties. Now, as mentioned by John, we have a number of flexible payment plan options across our deposits, and we'll touch on that now. So, as mentioned, the development completes in Q3 next year, comes with a 999-year lease. It has a 10-year build warranty and a deposit protection structure. If you want a short-term let it or Airbnb it, you can. So for reservations in 2024, which we've extended for the month of January, if you exchange on a 10 or 20% deposit, you will get £1,000 paid towards your legal fees, and you'll get free lettings and management on the property for the first year. Okay. Now, the first option that you can do is obviously a 20% deposit. If you use a 20% deposit upfront, you'll get 6% per annum taken off your completion balance. So for clients that don't want to have their money tied up in a deposit not working for them, you can actually get your deposit to work for you, and you'll get a free furniture pack on that property, which is anywhere between £2,000 to £4,500, depending on what unit you select. So to give you an example, on a one bed at £250,000, you can exchange on £50,000 or 20%. The time between exchange and completion, you'll get 6% per annum taken off your completion balance. At completion, your mortgage will kick in. Whatever your mortgage doesn't cover is what you need to make up in terms of a deposit. Okay. The second option you can do is a 10% deposit and the balance on completion. So same example, £250,000 property, exchange on 10% or £25,000, and then the balance on completion. Whatever your mortgage doesn't cover is what you need to make up in terms of a deposit. And then this is the third option, which John has talked about, where you can exchange on a 5% deposit. And then the remaining 15% is broken up into 18 monthly payment plans. So let's take an example of an executive residence, all right? Priced at £196,500, you can exchange on 5% or £9,825. And then the remaining 15% is broken up into 18 monthly payment options, which is £1,637 per month, which is really affordable. And it gets your foot in the door on the property market in the UK sooner. You've locked in a price per square foot, and you've got a manageable payment plan going forward. Okay. Now, how's your property going to look when it's completed in Q3 next year? So let's take an example of an executive residence. It's really good from a short-term lettings perspective. Your total equity required broken up into those payment plan options. Again, I've used a 65% loan to value. You could qualify for higher, but that's on a case-by-case basis. So before reserving your property, we can have a discussion with the mortgage broker to confirm your loan to values, your interest rates. But for an example, I've used a 65% loan to value, which is more than achievable for clients in South Africa. Okay, your rental income on a monthly basis is going to be £1,200 or £14,400 per annum. Your mortgage costs and fees, so that's your mortgage interest payments, your service charge, your lettings and management fee will total £727 per month or £8,700 per annum. So your net cash flow position, that's the money you get in your pocket every month, will be £473 or £5,600 over the year. Okay. After 5 years, assuming the Savills growth rates, that's what your property is going to be worth. You've built up more equity in the property. Because you're on an interest-only mortgage, with the growth in your property price, your loan to value is actually decreased, so you own more of the property. Your rental income is going to grow to £1,391. Your mortgage costs and fees have increased slightly, but not much. So your net cash flow position has obviously increased to £603 per month. Okay. Over that 5-year period that you've owned that property, your total rental income will be £76,000. Your mortgage costs and fees will total 46. So you £30,000 cash flow positive. That's in your pocket over that 5-year period. So your net cash flow position plus the capital growth you've got in your property is 73. You've put in a total of £80,000. So your return on investment is 90.8% over a 5-year period. Okay. Now, how's that going to look after a 10-year period? This is the property you've purchased. After 10 years, your property is going to be worth £293, not £293,000. Again, you've more than doubled the equity in your property. Your loan to value is also decreased with that property price growth. Your rental income is going to be roughly £1,613 per month. Your mortgage costs and fees are going to be 806. So your net cash flow position starts to increase. Okay, so your net cash flow position is £806 per month. So your total rental income over that 10-year period is £165,000. Your mortgage costs and fees are 93. So you're £72,000 cash flow positive. So that's what's gone into your pocket every month after all expenses. Okay. Your net cash flow position plus the capital growth is 166. Remember, you only put in £80,000, so your return on investment is 206.2%. Okay, so really good return on investment over a 10-year period. If you hold it for longer, your return starts to increase even further. So it's a really good long-term investment case. So that's pretty much the development as it is. John, do you have any questions or anything else you'd like to discuss?
Yeah, no, I mean that was really excellent and very, very clear and really exciting when you put the numbers to it.
Yeah.
You know, where could you get a low risk investment, really low risk investment, giving you 206% and over 10 years and 90 over 5 years? I mean, 5 years is just around the corner. Yeah, people remember 5 years 5 years goes very, very quickly. So I mean, it really is an incredible. There are a few questions coming through, but we'll answer them towards the end. Yeah, I mean that really is outstanding.
Yeah, I mean it's also the UK is one of the few places where property in general is one of the few asset classes where you can actually borrow to fund that property, so you can leverage it. I mean, it's the rich dad, poor dad scenario. The bank's not going to lend you money to go and buy stocks and shares because it's too volatile. I mean, it's going to go up and down. So they're happy to lend on a property. And when the property grows in value, the bank doesn't want any of that growth. They just want their interest payments. So you get all of the growth on that property price growth.
Exactly. I mean, you said it. And then again, you know, where could you take 25,000 or where could you take £80,000?
Yeah.
And turn it into £200,000 overnight. It's you're using other people's money. You know,
exactly.
Somebody else is putting their deposits, their money into the bank, and the bank's taking their money and giving it to you to make money. You know, it really is it's an unbelievable investment. Any property is unbelievable, and as you know, we all know, people don't go into property because they haven't got the deposit. You know, they've got to have 40 or 50,000 to book that property. No, you don't. You need, you need 5%. You need £9,000. You know, yeah, it really, and you know, people say, oh, you know, people say, you know, take pension funds or take borrow funds to go into stocks or shares. I mean, that's ludicrous. But borrow funds, you know, get your sisters or brothers or friends and put it into property, because you know it's very, very low risk. And you'll, yeah, can I say, touching wood a little bit, you'll most probably always get your money back on a property investment, at least.
Most likely. And also from a risk point of view, John, is that with the monthly payment plan option, when it comes to moving large flows of money outside of your country, so let's take South Africa, for example. If you're resident in South Africa, you can use your R1 million discretionary allowance. If you're wanting to put down a 20% deposit on a property, that R1 million will probably be depleted. So this not only manages that that exchange control and getting money out of the country, but then also, essentially, a lot of people are very hesitant to do it because they say, well, the exchange rate might strengthen, so I'm going to wait for the exchange rate to do it, well, to strengthen. And with that monthly payment plan, you're basically using the dollar cost averaging scenario, whereby you're averaging it out through a period. It doesn't matter what the exchange rate does, essentially, you're paying it off over a longer period of time.
Exactly. I mean, that's really a good point. And again, also from, you know, the banking world right now, you know, you transfer any large numbers, you know, it sometimes raises red flags. You know, I've done a lot of property deals with people in crypto, because you know, you take out £40,000 in crypto in one go. The banks will close your bank for you. They'll phone you up and say that you're too much of a credit risk. We don't want you, even if you've been I've had clients that have been part of banks for 20, 30 years, and the banks have just foreclosed on them purely because large sums have been going through crypto. Whereas this, you know, you take out £10,000 and then 1,600 a month.
It's manageable.
Can I say it's going to fly under the radar? I mean, I shouldn't be saying that, but it is going to fly under the radar. You know, because all banks have got, or all monetary movements have got levels that they adhere to.
Exactly.
I mean, it's been incredibly insightful. And you know, one residency from a payment plan point of view, I'm a big adage for payment plan. Is really, really an awesome investment to get involved with. It really is.
And also just leads in general, not many people realize. Now, obviously, we've got the Northern Powerhouse, so the government's trying to decentralize the economy outside of London. Now, Leeds is the second biggest financial hub outside of London, so that's where all the major banks are, the build-to-rent schemes, the pension funds. So Leeds is really starting to expand. The government is also allocating a lot of infrastructure spend in there, so that's just going to work even better when it comes to the long-term investment case. The population is growing, the student population is also growing, so it's a really solid investment case.
Okay, we've been going for quite a while. Maybe we should move on to the questions that have come through.
Okay.
Let me just have a look here. Okay, the obvious one, and we get a lot of it, is, how secure is my investment? You know, they're buying it when it's coming out of the ground. It's not there yet. How secure is the development going to be delayed? At the end of the day, I think Matthew touched on that. I know you can redo that if you want to, Matthew, with regards to the developers that we choose and that we only invest with.
Yeah, so When we take on a developer, so we're a distribution partner for a lot of the developers. When we take on a developer, like I said, we need to tick three main boxes. Those are non-negotiables. So the developer needs to have a minimum track record of 10 years. So Hive Living, which is Gareth Morgan and Zachary Wheatley, they've got over 37 years between them. So they've developed a lot of projects, over 40 projects, right? They've got a really good track record, not only for developing great projects, but also in great timelines. So no delays on their projects. So that was the first box that we needed to tick when it came to the development, or the developers, should I say. The second box is that the development needs to be fully funded. So what I've seen a lot in the past is that clients' deposits go towards the build. And that sometimes creates problems, most times doesn't, but sometimes does. So at least the development is fully funded. So clients' deposits are not going towards the build. And then the third thing is there needs to be a deposit protection structure. So just in the unlikely scenario that the development doesn't go ahead, at least you have peace of mind that your deposit is protected and you can get that deposit back. So yeah, those are obviously the three key points that we've ticked all boxes for.
Brilliant. Okay. Another one, a good question as well, because we didn't go over it because it wasn't really part, but it's paramount to people buying investment properties. Is it tenants? Yeah, how do I manage tenants if I choose to rent out the property?
Okay. So we've got Global Lettings and Management, which are our lettings and management business to our firm. They basically will source the tenants. They'll do the background checks, the draw up of lease agreements, and then collection of rental. They'll manage the property and pay the rental to the client. Everyone always says, well, I'm scared that there's going to be a vacancy and my rental income's not going to be paid. Well, we have a 98% occupancy across our developments, but what clients can do to give them peace of mind is take out what's called rental guarantee insurance. It'll cost probably about 12 or 13 pounds a month, so it's cheaper than a Netflix subscription. But in the case of a void period or vacancy on your property, that rental guarantee insurance will cover you for that month. So at least you know you've got that consistent income coming in every month.
That's really good to know. And yeah, I would recommend it to everybody. Yeah.
No, exactly. It's cheaper than a Netflix subscription, and you've given that peace of mind and that certainty that you've got your income coming in.
Exactly. I mean, all my projections that I do, I actually do between a 90 and 95% occupancy.
Yeah.
But for £12 and you will always get your rental. That's incredible.
It's a no-brainer, to be honest.
It really is. There's another one here about expected timelines for construction and what happens if they're late.
So with every property, when you have your contracts, once you've paid your deposit and your solicitors have drawn up your purchase agreements, right? They'll draw up the purchase agreements and contracts. If you're happy with the contracts, your solicitors will exchange them with the developer's contracts. And in that contract, there is what's called a long stop date. Okay. Now, this is a predetermined amount of time from expected to completion to the long stop date. So if the property isn't built by that long stop date, when that time comes, then essentially you can rescind your contracts and get your deposit back. Most of the time, given the developer track record, they've never gone past their long stop date. So at least you've got a peace of mind that the property should complete on time. It's an 18-month build, gives you flexibility on your deposit with that 18-month build, and then it should theoretically be completed on time. But you've got those avenues to protect yourself should it be delayed in your contracts.
Okay, great. Another one is, and I'll answer this as well straight away, is, can you use the payment plan on a number of properties? Yes, of course. That's how I often say that as well. If you have liquidity coming in on a monthly basis, and good liquidity, I would suggest you buy 2 properties instead of putting one big lump sum deposit down on one.
Exactly.
Because you can become a property baron overnight. Okay, another one about tax implications. That's a whole another webinar. Yeah, we can definitely help you with the tax side of things. Yeah, we will always refer you to our tax consultants that we use on a daily basis. But yeah, so yeah, I'm not going to answer in depth, but we'll come back to you personally on that one at the moment. Another one is, okay, another came in about the risks associated with this investment one, but we've answered that. We've answered that one as well. Oh, this is a good one, because I get a lot of questions. Can I withdraw from the investment if my circumstances change?
Is that regarding your contract? So before it's completed or afterwards?
I suppose before it's completed.
Okay, so obviously your contract will state the terms. With that, if you can't complete on your property, we'll need to look to sell that property to someone else. So that obviously can take some time. If the property, well, the development's all sold out, then usually you can sell it to someone else quite easily, which I think we should be able to. But yeah, obviously, before we sit down, rather than overstretching you on a monthly payment plan or a deposit requirement, is we'll run through the cash flows, make sure that it's within your budget and your circumstances, and then make an informed decision on selection of a unit going forward so that it's within your budget.
Okay. Yeah, so to carry on with Matthew said is that we will obviously help you try and resell the property as quickly as possible. But from a contractual point of view, you are contracted to that property. We have had cases. Unfortunately, I had a client that passed away. Yeah, we really do help resell the property, and yeah, but it could take a month or 2 or 3.
Yeah, just on that point, John, with clients passing away, there are provisions in your contract to protect you in circumstances like that, usually.
Okay, good. On top of that, what happens if I miss a payment? Sure, there are lots of questions coming through.
So if you miss a payment, you would just need to make up that payment on your next month or the next quarter. So it's just to keep up to date with your payment records. It also just helps people from a cash flow perspective and managing their payments going forward.
Okay. And are there any other hidden fees, costs? We've been quite transparent talking about certain costs during the webinar. Are there other hidden fees that we haven't spoken about?
The fees that you need to mainly focus on, right, are your legal fees. As mentioned, with certain deposits, we will contribute towards your legal fees. Those are the first fees that you need to incorporate. Secondly, if you decide to take a mortgage, you've got mortgage broker fees and lender arrangement fees. Those are all within your mortgage package. When you basically got a mortgage, the lenders agreed to lend to you. What they'll do is they'll send out a surveyor to make sure that the property is worth what you're purchasing it for, and also to confirm what they'll be able to lend to you. So there is a valuation fee. It's roughly about £350, but that's to send a surveyor out to value your property. And then the last fee is stamp duty land tax, which is a transfer tax in the UK. There's been a lot of talk about that recently with stamp duty changes, but essentially it's a percentage of the property price based on where you're resident, whether you're going to buy to let it or whether you want to live in it. Although it is a percentage and it is a tax amount, you can net that off against your capital gain when you sell it. So it might be an upfront tax now, but essentially you can net it off later on down the line when you decide to sell that property.
Okay, brilliant. Yeah, we're going to have to start wrapping up. I'll just do 1 or 2 quick ones. Can I visit the construction site? Of course.
Absolutely.
100% you can visit. What happens what happens to my investment if the developer goes bankrupt? I think we've sort of.
Yeah, so there's a deposit protection structure in place in the development, which we've touched on.
Yeah,
so
yeah.
Deposits are protected.
That's correct. And how do I get started? Well,
All right. Yeah, so essentially what we'd do is we can have a joint meeting, John, discuss the development in more detail, go through the units, and then if you want to confirm lending, we can have a meeting with the mortgage broker. But essentially it would be to reserve your property would be to fill out a reservation form, okay, with a copy of your ID, a proof of address, and then the reservation fee to take that property off the market is £5,000. That's deducted from your deposit. So yeah, that's obviously to reserve the property.
Okay, cool. You know what? I'm going to wrap it up there. There are a few questions we haven't answered, but we'll just get back to those questions personally on a one-to-one. But really, Matthew, thank you very much for joining us today. And hopefully we'll see you again with some more of your wonderful developments that you have.
No, definitely. Yeah, we've got a few exciting ones coming up.
Okay, brilliant. Thanks, everybody. Thanks,
everyone.
Cheers. Thanks.
Bye.
Bye.